everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, Head of Fixed Income Strategy at Wisdom Tree Asset Management. We are kicking off the month of December with a great guest in the studio today, Jim Bianco from Bianco Research. Jim, welcome to the podcast.
Hey, thanks for having me, Kevin.
So here we are, as I mentioned, in the month of December, and a year ago we partnered with Jim and his team who produced the Bianco Research Fixed Income Total Return Index, and we turned it into an ETF, ticker WTBN, the Wisdom Tree Bianco Total Return Fund. So, Jim, I just wanted to, give our listeners a sense here. What are the premises? What are your underlying considerations behind the index? Because we look at this in our Perlay as more of a active core approach. So just walk our listeners through a little bit some of the underlying components within the index.
Yes, and thanks for having me. First, I should say we do manage an index, and just so people are clear as what that is we have an index, a broad-based index, similar to the Bloomberg Aggregate Index or the JP Morgan Broad Investment Grade, and we intentionally tilt the index, whether we want to have duration be the sensitivity to interest rates, overweight or underweight a benchmark, credit, overweight or underweight a benchmark, and the like. Think of us like the S&P Index Committee manages the S&P 500, and then there's several ETFs that track that index. We manage the Bianco Research Total Return Index. You can find about it at biancoadvisors.com. It's got its own website. And WTBN tracks our index. So that's how we manage what we do. So we're the index managers. Why now? What are we trying to do? We started, as you mentioned, the ETF started tracking our index on December 20th of last year. So we're coming up on the 1-year anniversary. The reason we picked that date, late 2023 to be specific, not that date as a day, is that at that point, interest rates had moved from 0 to well over 4.5% on the 10-year yield. That was a painful process to get yields up that much. It produced total return losses. Looking at some of the data that Ed McQuarrie at Santa Clara University does, that you have to go back to the Civil War to find another time to be a bond holder to have suffered through that many losses. Okay, that period of getting interest rates from 0 to 5%, which means the prices to go down for the yield to go up, is over. And we looked at the bond market and said, now that there's a yield again, and now that we're already at 5%, it presents real opportunity for investors as a core holder. Prior to that, when it was at 0, it used to be considered the bond market kind of like crash insurance, right? The 60-40 portfolio, the 40 leg, when the Fed funds rate was at 0 and 2-year and 10-year yields were at 2%, was you owned it because if the stock market crashed, then you'd get a risk-off rally and bonds would rally. Today, because of that yield, bonds are now a competitive investment considering the alternative of, say, the stock market. And we've also looked at the bond market, and we understand that in the stock market, we being everybody, we understand in the stock market, most active strategies cannot beat the index. So that's why things like the S&P 500 and the Russell 2000 and the NASDAQ 100 are extraordinarily popular tools. I've given up on picking stocks, just own the index. It outperforms all professional managers, or most. That's not the case in the bond market. In the bond market, the history shows you that about 50% of professional managers can outperform an index like the Bloomberg Aggregate or the JP Morgan Broad Investment Grade, or BIG as it's known. So we've wanted to push this idea of that an active approach through kind of our tilting of the index can work for a fixed income, for somebody looking for fixed income, as opposed to just buy the index and hold the index. Active managers can add value, and most of them do, actually.
It's interesting. I know you and I have been in the bond market, let's call it multi-decades, but even we, Jim, we don't go back to the Civil War.
Right.
So, I wanted, obviously, like you said, since we launched in December and even going back to October of last year, it's really been a roller coaster for the Treasury market. Let's just focus on the 10-year yield. So, when we're looking at things here year to date, give us a sense, what were we focusing on within the index slash fund, and where are we now, say, as compared to the ag year to date?
So I'll take the second half of the question first. Our Bianco Total Return Index is about 140 basis points ahead of, say, the ag. That's year to date through the end of November. And it has been a very satisfying, first year, because we've done a job that we've set out to do, and that is to provide value beyond owning just the index. And our performance has delivered at least that in year one. Now, why did we get there? How did we get there? First half of your question. I think really a lot of the question really comes down to the inflation. I've been of the opinion that the cycle for the bond market turned in 2020, and then we're in a multi-year bear market for bonds. And here I am with a bond index and talking about a bond ETF, and we're in a bear market for bonds. But the difference is, now that we've gotten to a 5% yield, there is a yield now. It isn't just buy bonds and watch the price go down and lose a lot of money. That was 2020 to 2023. Now there's a yield, and there's a yield to be managed, and we're up about 4.5% year to date on our index, thereabouts. I don't remember the exact number, but it's pretty close to that right now. And that's because of the big coupon. And in years where we will see people believe that the economy is slowing, inflation is not a problem, we'll see better returns. Years that you'll see the economy picking up, inflation being kind of a question, that was this year more the first half of the year than the second half of the year. You will see bond yields, struggle. You'll see the bond market struggle, but yet with that coupon, we're still up 4.5%. And in this environment, a bad year is now +2. Or maybe +3. A good year might be, and I'm talking about the overall market, might be +6, 7, or 8. Where in the stock market, a bad year could be -20. We saw that 2 years ago. And a good year could be +25. So the stock market has a lot more risk, but it also has, a lot more reward, but it also has a lot more downside. The bond market can churn out these numbers that you should look at, in terms of, 4, 5, or 6% because of the coupon and the outlook for the economy. The last thing I'll mention about that is Dr. Jeremy Siegel, who's, does a lot of work with Wisdom Tree 2. He looks at the long-term prospects of what should you expect out of the stock market going forward. We know it's up 26% this year. We know it was up about 25% last year. What about next year and years to come? Well, if you look at the valuations of the market and everything, bottom line, he says, about a 6 to 8% return is somewhere where you should expect the stock market because of the high valuations. Valuation is not a timing tool, but it is a good expectation tool. Higher valuated stock markets usually produce lower returns. But in this case, maybe 6 to 8%. The bond yield is the yield on our index is around 4.90. So it's almost 5%. So you're getting most of the stock market's returns with a lot less of the stock market's risk. Like I said, a bad year at this point might be a +2% after we've gotten from 0 to 5. So therefore, if you look at the bond market, it all of a sudden looks like it's a good core holding for an investor in its own right, unlike the 2010 to say 2022 period, where it either returned you nothing and then lost you a lot of money. That coupon return really does change a lot of the outlook for the bond market.
I think, I couldn't have stated that point any better. And for a lot of our listeners out there who perhaps aren't used to what I think Jim and I would refer to now as more of a normal rate setting as compared to the 2010, 2020 period, it does take almost a re-education or a new education for a lot of investors and advisors who are used to zero interest rate policy, negative rates, 1%, 2%. And that's why I think for us going forward, focusing on this active core strategy that Jim's index represents and our fund represents is something that we're going to certainly underscore as an important part of your bond portfolio decision-making process for 2025. So I'm going to leave it there. Jim, it was great having you on. For everybody out there. We will be doing this on a regular basis. We'll bring Jim on, give us his updated thoughts and insights, because it promises to be, I think, another fun year for the bond market. So, Jim, great having you.
Look forward to our future talk.